Thank you, Matt, and thanks for hosting all of this. My name is Marissa. I live here in the village, and I'm one of the most frequent, probably, visitors to the library. Um, I just do quick introduction. We're doing this through the Association of Financial Educators. I'm a volunteer for them, and the commitment is to try and increase financial literacy. I have my own financial advisory practice, and it's focused on comprehensive financial planning and investment management. Today's the third in our series through all of January about financial planning for retirement. And today we're going to be focusing on paying for healthcare costs in retirement, which is um, usually one of the biggest, if not the biggest, expenses people can expect to have to pay in retirement. So an incredibly important thing to be planning for to make sure the rest of your goals fall into place. So if you have questions along the way, go ahead and type them in the chat box. I will do my best to monitor that while I'm also managing to speak and follow the PowerPoint here. And then at the end, we'll have some extra time for questions. If you have anything specific or personal that you want to ask, but you feel uncomfortable or we run out of time, you have my contact information, I believe, and it's on, I think, the library website. So go ahead and reach out to me directly. I'm happy to serve as a resource. So let's get started. A quick preview of what we'll be talking about today. We will, and for those of you who have joined me in previous weeks, it'll be a little bit of a refresher, but we'll talk about briefly the 8 key retirement decisions. We'll get into the meat of today's discussion, which is exploring the guidelines around using a combination of insurance and savings to cover for your healthcare costs and long-term care costs during retirement. And we'll be including an introduction to the different types of Medicare, which truly is complicated enough to make anyone's head spin. So I'm going to try to stop the head spinning and give you some sort of sense of order and how to really navigate the Medicare system. And then I'll conclude with some additional ideas of places where you can go for help. Not surprisingly, a 40-minute presentation is really just the tip of the iceberg for all that there is to understand on this. But I won't leave you hanging. I'll give you some next steps and places to go. So as we mentioned in the previous presentations, important to remember that insurance is not the one and only piece of planning for retirement. Retirement is a holistic process, and each decision area affects the other areas of consideration. So all of the questions shown in this illustration are connected to that one major question in the center, which is how much of a regular retirement paycheck can you expect to pay yourself? And the answer to this is going to depend on various factors: work, benefits, housing. By piecing together these different streams of income and appropriately growing and protecting your assets, you can make your nest egg last longer during retirement. So if you've joined us in previous weeks, you get bonus credit. But beyond that, you'll know that the 8 key decision areas are Social Security, home and mortgage, insurance, retirement plans, savings and investment, debt, fraud, and work. In next week's final seminar, we'll address how to avoid scams and fraud, and hopefully you'll join us for that as well. You can also visit the Kinderhook Library YouTube channel and see our previously recorded webinar on what to consider before claiming Social Security and how to plan for income in retirement. So the first thing to think about in planning for your medical costs is what will your medical costs be? And this is sort of, when you're first planning for your retirement medical costs, you're probably pretty healthy, and it seems like a very far off thing to even try to figure out. So with the knowledge that the costs related to your medical treatment and long-term care will make up the significant portion of a retiree's budget, it's incredibly important to prepare for the fact that not only are healthcare costs already significant, but they're also anticipated to rise significantly faster than any other retirement spending category. When I'm running projections, I estimate a 6% inflation on healthcare expenses, which compares to general inflation on things like milk and entertainment of about 2.25%. to give you an idea of just how much more you really should expect that at the current rate, your medical costs will increase. Today, a couple aged 65, if let's say they were recently retired, should anticipate about $300,000 in healthcare costs during the remainder of their lives. Importantly, that and shockingly, that doesn't even include long-term care costs. So the $300,000 expectation is assuming you live a nice, relatively healthy life and never even need to go into a long-term care facility. What if you do? Like 1 in 3 people need long-term care, however. This is, apologies to those of you who are out of the state, but this is the central New York average costs. Long Island, I know you're down there on Long Island, has its different costs, and you can go to Genworth. They have a good estimator, go state by state, area by area to give you an idea of what you might expect for long-term costs. I think these numbers are kind of amazing. That your long-term care cost, again, we're not talking Manhattan, up here, central New York, a nursing home for a semi-private room is $427 per day. Assisted living is about $158 a day. But if you just I take a moment to let that sink in of how incredibly expensive that is, if you end up needing nursing care for a long period of time, that's more than staying at the Marriott Marquis for a night in the middle of Times Square. So again, why I think this is such an important topic to address before you get to the point where you need the care. So a common dangerous misconception is that Medicare covers everything for you medically. This is the one thing, if anything, from this whole presentation, I hope you walk away with. It is not true. Medicare, especially Medicare Part A, is a limited type of insurance, and it does not cover everything. So let's take an example of someone who has had a stroke. And figure out what might be covered by Medicare Part A and what probably isn't. So we have, So the Medicare Part A and will cover you for some, if not all, depending on how long you're in the hospital. It'll cover you for your inpatient care, your doctor expenses while you're inpatient. If you have Medicare Part A will cover you for your medical supplies inside the hospital. If you have Medicare Part D, it'll cover you for medication afterwards. And it'll cover you for some rehabilitation in a nursing home, with the very, very important caveat that it has to actually be medically necessary care. Medicare will not pay for custodial care. So if you, let's say you trip or you have a stroke and medically you're okay, but you're unable to, because of the stroke, you're unable to bathe yourself. Medicare is not going to step in for the custodial care for those activities of daily living that you can't do because of the stroke. So that's where you'll be covering it on your own. So the fact that the stroke caused you the inability to feed yourself, bathe, groom, dress, or move, you're on your own, or as we'll get through later on in this presentation, you'll figure out a different form of insurance, hopefully before you've had this stroke, but it is not going to be covered by Medicare Part A. So how do we talk about, where do you go to even think about what kind of medical costs you might need? AARP has a retirement planning healthcare cost calculator that, as of this morning, actually the link is working, but the calculator is not currently up. So I also included the Social Security longevity calculator here, where you can go in and see how long are you expected to live, and it has all sorts of calculators, and this is on ssa.gov, so just the Social Security website. Medicare.gov also provides an incredible amount of information about how to estimate how long you will live and what type of healthcare costs you might experience based on your lifestyle and also based on how your parents fared in their older age. So let's talk about if you are, we're going to, the second half of this, we're going to talk about the insurance to try to avoid you getting into any sort of unbearable medical debt. But let's say you're that stroke victim that we just talked about. You didn't realize that Medicare Part A wasn't going to cover you, and now you're stuck with all of this medical debt. What do you do? The After you've probably panicked and freaked out a bit, the first thing to do is review your bills for errors. This is a huge mistake. Don't just accept the receipt and say, oh yeah, oh I got that, oh look through it, make sure you actually received all of the services. I have heard so many times of people who they looked at the thing and said, well, I never even got anesthesia. Why is that on my most people? I would imagine a lot of people don't review their bills for errors, and it just goes, look at your bill just like you would look at any receipt. If it is something you can't afford to pay right then, you can ask for a payment plan. It never hurts to ask. You can also ask for a discount. Hospital might think, oh, it's better to get paid something than to not get paid at all. So don't try not to be scared by the administration of a hospital. Ask for whatever you think you might need. And if it gets to the point where you really don't have the funds to pay the bills, and we'll talk about Medicaid later on, but find out if you qualify for Medicaid, and that can take some of the burden for paying for these healthcare costs off of you. So for those of you who have joined me before, I like to do these quick check-ins to make sure you're all still awake. So the first one, even you can nod or put yes or no in the question box, is that long-term care expenses are paid by Medicare. No, good, okay. If anyone got that one wrong, I would, I feel like no one was listening. So the next one is, once a person dies, all of his or her medical debt is forgiven, and the spouse does not need to repay any of the debt. What do you think? Let's see. Okay, so this one is, I think, a pretty interesting question. It actually depends on what state you're in. Assuming you're not in a community property state, and I don't believe any of the people who are on here today are, in a community property state, the government sees all of your assets as totally one unit. New York is not, New Jersey is not. So so what that means is your spouse will not be liable for your decedent's bills. That is, unless you co-sign for them. So an important thing when you seek medical care is, if possible, do not co-sign for those medical expenses if you want to be able to protect the spouse from being liable for your debts. One thing to know about it, though, is just because the spouse isn't liable for your debts, if you pass away, your estate will be liable for those debts. So the executor or personal representative appointed to manage your estate after you pass away will pay, their primary job is to pay your bills as part of the probate process. So if you've incurred a whole bunch of unpaid medical expenses at your death, your personal representative or your executor is going to collect all of your assets, see what the estate is, and then pay out to the creditors. And often your medical creditors jump to the front of the line, so they would get paid first. What's left at the end of that process will get distributed to your beneficiaries as you intended and probably wanted. An really interesting planning piece here, and one I would probably advise talking to an advisor in more depth about before making any moves on this, but sort of just a thing to be aware of, is that the executor or the personal representative is not going to be able to use any non-probate assets to pay off your medical debt. So sort of breaking it down for a second, if you let's say you have an IRA, that won't be a probate asset as long as you have a beneficiary designation on it, let's say naming your child for when you pass away. that, or if you have a taxable let's say a standard savings account, but you have a transfer on death designation on it, so that immediately at your death, that account will transfer without going to probate to your beneficiary. Those assets go directly again on your death. They're not going to go through probate, meaning that your executor, when he or she goes to collect all of your assets, isn't going to be able to include those assets that transfer directly. So they can skip the creditor, or at least the healthcare creditor. A major caveat here is that the creditor can still go after those assets if there's even a whiff that you move these assets into transfer on death or to avoid probate, specifically to avoid paying your creditors. Most people have beneficiaries on their IRAs because that's just the smart, easy thing to do. And it would be very hard to prove that it was done just to avoid paying a debt. But certainly a more complex planning consideration, and one I encourage you to think about and maybe get additional guidance on before making any significant changes. So, as I've hopefully made clear so far, and I think I did, and you all answered the previous question before, but Medicare does not cover everything. Fortunately, insurance options are available during retirement to help cover the financial costs of medical and long-term care, so we don't end up in a situation where your estate is having to pay out everything for your debt. Insurance in general is a strategy of sharing the burden of your financial loss due to illness and accidents. When you purchase your insurance policy, you're pooling money with others to share your risk. While insurance is not an income stream per se, it does allow you to mitigate your incident costs so you can preserve your other sources of retirement income. So I'm going to continue by discussing the 4 different types of medical insurance for in retirement in greater detail. It's Medicare, and I'm sure you've all at least heard these terms, if not confused as to which one is which. But it's Medicare, Medigap, supplemental insurance, long-term care insurance, and Medicaid. An individual who qualifies for Social Security, retirement, or disability benefits also qualifies for Medicare benefits, which is typically no earlier than age 65, which is why I started this by asking which of you guys are 65 and already on Medicare. So thanks for sharing, so I know where we are here. So the 4 basic types of Medicare coverage. Part A, we've talked a little bit about already, which is hospital insurance. It covers you for inpatient care in skilled nursing facilities, hospice, and home health care, but very, very importantly, so I'm going to repeat it again, no custodial care. Part B is medical insurance, and this is more of what you are probably used to as, having general employee group health insurance. It covers your doctor services, hospital outpatient care, home health care, and some preventative services. Part C is called Medicare Advantage Plan. It's one of the newer parts of the Medicare package, and it works the most of all of these like your regular old health insurance that you were used to while you were working. It can be an HMO or a PPO. And what's lovely about a Medicare Advantage plan is it groups together parts A and B and probably part D. So, and it's provided by a private insurance company that's been approved by Medicare, but is private and works the most similarly to what you're probably used to of having while you were working. Part D is the prescription drug program. It is designed to help cover the costs of prescription drugs. And in 2020, it's gotten, it's probably the most generous it has been since it was invented to provide the significant bulk of coverage for your prescriptions. So as long as we're busy dispelling myths, we know Medicare doesn't cover everything. So is it at least free? No, it's not free either. The reality is Medicare is not at all free. There are premiums, deductibles, co-insurance, co-payments, and they need to be paid by the policyholder and should absolutely be taken into consideration when you're estimating your medical expenses for retirement. Part A, which is the hospital insurance, as an example, it's the one piece that doesn't have there's no there's no premium, so you don't have to pay for it on an ongoing monthly basis, and you're automatically eligible and a part of it just by enrolling in Social Security. However, there is a deductible for each benefit period, so you have to pay the first $1,400 of each benefit period before Medicare Part A is going to kick in to cover you. Also, usually surprising to most people, while Medicare will cover you for the first 60 days of your inpatient stay, from day 61 to day 90, you have to pay a percentage of the care. There's also, after day 91, you're going to have additional costs, and then it will actually, after you use up your lifetime reserve, you're going to be on the hook for all of it. So it's absolutely not limited. You're on the hook for a lot of inpatient care if you're in the hospital before 90 days in a period. So for skilled nursing care, it's similar, even though Medicare covers skilled nursing care, again, as long as it's not activities of daily living, you really only get the first 20 days for free. After that, you're paying $185 per day up to day 100. And after day 100, Medicare drops off and it's all on you. So these are pretty significant costs. And unfortunately, if you end up in a hospital, you're not really going to be in a place to be able to say, oh, well, I'd rather not be here. Most people want to walk out of a hospital as soon as possible. So it's incredibly important to plan around these expenses. Part B is the Part B medical insurance. This premium can vary by your income, but the standard monthly premium is about $149, and here the deductible is about $200. Except on top of that, there's also a 20% copay. So again, Part B is not free, and in addition to your deductibles, you also have an annual premium that will most likely come automatically out of your Social Security statement. If you want to opt out of Part B, you can, and I'll get to it a little bit later, some of the considerations for not opting out of Part B. But let's go into Part C, Medicare Advantage Plan. These plans charge additional premiums and the copays vary. Alan down there had mentioned that he's got Medicare Advantage through AARP. That's one of the more popular ones you hear of, but there's many, many different kinds of insurance companies offering Medicare Advantage plans, and it varies by state. And the types of plans they offer it's either Plan A, B, C, all the way up to L or M. And each of those is regulated by Medicare. So the benefit package is the same, but so what's the difference between going through AARP or, let's say, United Healthcare? It will vary on which of those types of plans they choose to offer, and it'll vary on what the actual cost of the premiums will be. So there's many, many different considerations here. It's a good time to talk with an advisor. It might be a good time to talk to your primary healthcare physician to see which type of policy would make it so you can keep working with them if you want to do that. It's also important to review what kind of medicine you personally need, what prescriptions you're on, and try and get an Advantage plan that is going to cover you for what you need. So it's a little bit of a bummer again. This is one of my more I would say depressing presentations here, because here we go again, which is that some of the things that Medicare does not pay for, we already talked about. It won't cover you for long-term care. It doesn't cover you for dental care. It doesn't cover you for acupuncture or hearing aids, and any cosmetic surgery, unless it's because you were in some sort of an accident and that's part of the ongoing care. Most nursing home care, just to note, is custodial care. So most of what we think of when we think, oh, my parents had to go to a nursing home, that probably was nursing. That probably was custodial. So bathing, dressing, using the bathroom, and eating, or personal needs that could be done safely and reasonably without professional skills, that's called custodial care. So it may be necessary to have skilled nursing care, like changing sterile dressings. That would be covered by Medicare Part A, but anything beyond that is not. Uh, so how do you enroll? I alluded to this just a couple slides before. You can enroll in Medicare at any time, but is a myth. Again, you can't. You need to follow these rules. The penalties that can apply to messing up your Medicare enrollment can be very significant. So if you do not sign up for Part B and you decide later on you want it and you haven't been covered by a group policy in the meantime, but let's say you're on Medicare Part A, you're retired, you just think, you know what, I'm healthy. Why do I need Part B? I'll pay for it. I'll sign up for it in 5 years when I'm not as healthy. That's going to cost you 10% for each 12-month period you could have had Part B and didn't sign up. It's what the premiums will go up for you. So there's no open enrollment period. There is an open enrollment period every year in the fall. So you can't just, if you change your mind in the middle of the year, you still have to wait till open enrollment period in the fall to make the decision to get back onto Part B. That said, the caveat here is if there's an exception for people who have continued to work or maintain their own insurance through their group. And then let's say you're working until you're 70 and now you're off your group insurance. Now you can go ahead and sign up during open enrollment for Part B without the penalty. It's what they're trying to discourage is people waiting to pay for it until they really need it. Because the whole point of insurance is that some of the healthy people are subsidizing the less healthy. I really would recommend, and you've probably already seen a copy of this somewhere, but you can go on to Medicare.gov, and every year they publish the Medicare and You, which is a hefty tome of information and everything you ever wanted to or didn't want to know about Medicare and all of these different calendar choices of when you need to get on A or B or Medicare Advantage. It's all there. And there is a PDF that you can download and print. And it's worth the trudge through and the reading. So I've made it very clear that Medicare alone is probably not enough if you really want to protect your assets. And make sure you're able to cover all of your healthcare expenses. So what do you do to cover for these otherwise uncovered expenses? The first thing is called Medigap Insurance, and this is formally known as Medicare Supplemental Insurance, which you may have heard about before. And it covers your co-insurance amounts, your co-payments, and your deductibles for the cost of Medicare provided services such as Parts A and B. So all those things where under my myth that Medicare is free, Medigap can come in and cover some of those gaps. It does not, and this is the critical difference between Medigap and Medicare Advantage, it does not provide additional coverage for additional types of benefits. It simply covers the uncovered costs for your covered Medicare benefits, which is co-payments, deductibles. But it's not going to say, okay, well, now you can also have coverage for your hearing aids. When purchasing your Medigap supplement, it's recommended to do the following. You should buy the policy at the time of your enrollment in Part B. If you wait until a later date, again, some people think, oh, I'm healthy now. Why am I paying this extra money for Medigap? The disincentive is that you may be denied later on because you might have a medical underwriting as a poor health condition. Let's say you say, I don't need it, I'll wait till I'm sick. Well, they don't think that's so funny. You're going to have to then wait 6 months for your pre-existing conditions to have pre-existed before you can now get the Medigap coverage. So again, similar considerations for when you're looking for your Medicare Advantage plan is consider your health history and your prescription drug use. Make sure your own doctor works with the Medigap policy that you're looking at. I'll encourage you again to look at Medicare.gov, where they outline all the different types of uh, Medigap policies there are and the advantages or disadvantages amongst them. So Medicaid is, this could be another myth, is that Medicare and Medicaid are the same thing. I wish they had different names because they are quite different. Often confused though. So Medicaid is a joint federal and state program that helps with medical costs for some people, but only those with limited income and resources. Medicaid also offers benefits not normally covered by Medicare, such as nursing home care and personal care services. Each state has different rules about eligibility and applying for Medicaid. So I encourage you to look at, again, you go to Medicare.gov, or you can look at your own state's Medicaid benefits offices to see what the rules are in your home state. Um, the general rule is that a single applicant for Medicaid who's 65 or older can only have $2,000 in liquid assets. So that's cash, stocks, bonds, CDs. To be eligible for Medicaid, that again, that's all you can have is $2,000 in your name. New York is a little bit more generous, where a single applicant is allowed to have up to $15,750. Again, that's not a lot. So to get down to be Medicaid eligible, you really have to have spent down your other assets. Your primary home in most states is excluded up to a value of, it depends on states. It can be up to about $600,000 in most states. Some states go up to $900,000, but that is dependent on even if you're in a nursing home, you plan on returning to the home, or you have someone else who's already, like a spouse or a child, is living there. You can't just hold on to your primary residence as a way to hold on to the asset. You can also have one car, and you're allowed to prepay for your funeral and burial funds, and you're allowed to have life insurance policies, although the cash value of the life insurance policies will be counted towards your net worth as far as Medicaid goes. So what often happens for people is they go into a long-term care facility. Medicare, again, not going to pay for it as long as it's just custodial, or let's say it's skilled, but you've used up the Medicaid benefit period, and now you need to keep paying to stay there because you do need the care. And what you're going to start doing is spending down your assets. Eventually, you may get to the point where and it happens not infrequently, you'll get to the point where you've spent down all of your assets to the point where you're now Medicaid eligible. And at that point, Medicaid is going to step in and cover your costs, so you're not kicked out onto the street. The problem here is most people do not spend their lives working and saving and investing to end up broke and not able to leave anything to charity or to their children. The point was not to spend it all on a nursing home. So that's where all of this planning really comes in and is important. Thinking about where are your assets and do you have the proper coverage, to make sure that you're not ending up with your last dollar spent. One very, very interesting, I think, unique piece of New York, it's New York, California, Texas, and Florida. So just for those of you who are here in New York, you actually don't have to count the value of your IRAs or 401ks in your Medicaid eligibility. So as long as you're receiving the income from your required minimum distribution period, so at least 72, you could have, let's say, $3 million stocked away in a 401k and still technically be on Medicaid. If you're so the problem is your income stream will count towards your Medicaid eligibility, but that $3 million that's sitting in the 401k does not count towards Medicaid. So again, another complex piece of this puzzle, and one to certainly be aware of and think about with an advisor, is how are your assets positioned to prepare you for these long-term costs, but also if you ended up needing to be Medicaid eligible, set yourself up properly for that. And these are things you need to do in advance. There are look back windows of 5 years where if you gift out or get rid of all of your assets within a 5-year period before needing Medicaid's going to look back at all of that and still count it as part of your assets. So you can't just wait until the day you're really sick and need a lot of care to then say, oh, I want to give away all my money so that way I can get Medicaid. They've thought of that and they won't let you do it that way. So another way of protecting, if we're hoping to avoid the Medicaid route, is long-term care insurance. People who bought long-term care insurance many decades ago, it's awesome. They probably may have a good policy. The purpose of long-term care insurance is to avoid depleting all of your assets on your possible long-term care expenses and to avoid being dependent on your family or others for your activities of daily living. It's also you're trying to protect your net worth to ensure you have that financial legacy for your spouse or your children or for charity instead of just spending it all on your own long-term care needs. Um, Long-term care has sort of been a fraught place over the last couple of years where premiums have been going up exponentially. When long-term care first became a product, people weren't living as long, and no one realized that, oh, if you have long-term care insurance and you're in a nice facility and you're taken really good care of, you're probably going to live longer. So long-term care insurance is getting reinvented every day, and the cost has gone up and up and up. Just in my career, I've seen that happen. And so there's a lot to consider about looking at a long-term care policy. What is your current health? What's the cost of the policy? Can you afford that cost? Is it better for you to just self-insure? What is the quality of the insurer? Is it possible they're going to go under? They'll accept your premiums for decades, and then they're going to end up going bankrupt and not be there for you. There are also a relatively new product out there that I've seen is it's a long-term care with with a life insurance rider component. So it'll be if you have a set long-term care benefit, let's say you end up not using it, you pass away, you don't need that, then there's life insurance kicks in and your survivors get the life insurance piece. So it's not just use it or lose it. If you don't use the long-term care, you lose out. You will at least get the life insurance benefit. Again, it's a very specific need for very specific cases, and I would encourage you to explore it further than what I'm able to do here in just this 1-hour seminar. Briefly, long-term care insurance benefits, usually there's an elimination period. When you're figuring out what policy you want, the longer the elimination period, the cheaper the policy will be. It could be 60 days, 30 days, 90 days. And also you can figure out in setting up the policy what you want the policy to cover. Do you want it to cover only for skilled nursing care? Or do you want it to cover, there are some policies that cover for having family members who are taking care of you, it will reimburse them. Almost an infinite type of different types of long-term care insurance when you start to consider them. These are some of the primary factors in the premiums. And importantly, not everybody is eligible for this coverage. Long-term care providers really, unlike Medicare, they can pick who they insure and tend to prefer the healthier people. Ironically, of course, for those who are unhealthy and probably need the care more. It's another reason or incentive to consider your long-term care insurance options earlier and not after you already have a pre-existing condition that might make it harder for you to get the care. I've mentioned most of these already, but briefly, always look at the company name. Is it reputable? How long has it been in the industry? What's the financial stability? Talk to different agents. Don't ever feel like you're being sold something. The long-term care insurance policy, like any insurance policy, is for many people one of their largest lifetime investments. So ask questions, feel comfortable about it, talk to an independent advisor, talk to your medical care providers, and make sure you feel completely comfortable about this investment. Okay, so that was a lot. So we're going to do another little wake up call here. Let's see who's still with me. Medicare Part C, also known as Medicare Advantage, basically replaces Parts A, B, and D if the Advantage plan you select includes drug coverage. I'm going to make you nod your head just so I can see the blood moving back and forth. Okay, so yes, that's correct. Next one is long-term care insurance helps defray the cost of Medicare Part D. Let me see some head movement. There we go. You got people awake. Correct. That's not that. Those won't help you. So some in-home care considerations. When I'm working with people to prepare for long-term care, I think the first most critical question is, how do you ideally want to be cared for as you get older? And it's a hard conversation to have when you're relatively young and healthy, but now is the time to have that, when you can set it up for how you want it to ultimately be. Would you rather be in a nursing care, or would you rather be in home? What are the costs? If you are able to, it's certainly important if you are thinking of staying home, and that's what your preference would be. Is your house handicapped accessible? Would you be able to move your handicap bathroom in the bedroom to the first floor so that it's all handicapped accessible? These are sort of the things that you should be thinking about while you still can and you have the flexibility to do so. So I mentioned at the beginning here, which was you can delay enrolling in Medicare Part B if you still have your employer health insurance. This is, as people continue working longer, one of the major reasons people keep working past 60 and past that even more, and certainly up to 65, is so that you have your employer health care. Does it make sense to keep working for health care after you turn 65? It doesn't necessarily need to be the reason to keep working, but you do still get the benefit of being able to have both Medicare and your employer health care serve you. And you can have Medicare as the backup, and the employer health care covers the first bulk of care, which is almost always better than what you would get through Medicare. So you can keep maximizing your health savings accounts, and your HSAs can be used after you're done working to cover whatever gaps there are in your Medicare coverage. So life insurance is another way of protecting your beneficiaries. I certainly think life insurance is more important now that long-term care insurance has become out of range for, it's just become too expensive for a lot of people, and there's too much elimination for pre-existing conditions. What you can do with life insurance is you buy the policy outside of the cash amount. That has nothing to do with Medicaid eligibility. It doesn't go through probate, so it's protected from your creditors at your death. It just automatically transfers to your beneficiaries. But what you're able to do is use your current cash flow to pay premiums on your life insurance, so that even if you use down all of your assets by paying for long-term care, let's say, and even if you end up on Medicaid, when you die, that life insurance policy will kick in to pay your beneficiaries, to leave that legacy that you were hoping to leave. So life insurance is, I think people often think life insurance is just for young people who just had a baby and need to cover the cost of if one of the working spouses dies, and it's just for young people. And more I'm seeing life insurance being used as a long-term care, a form of asset protection for long-term care needs. So some basic tips as we're wrapping this up. Health insurance is I think we all know you took a Saturday morning to be here and talk about it is incredibly important, and doing a consideration of how you're going to pay for your health costs throughout retirement before you get to the point where you really need them is one of the smarter things you can do in planning for your retirement. Some key takeaways: if you won't be eligible for you won't be eligible for Medicare until you're 65, and so until then, try to use a spouse's employer provided healthcare plan or your own as long as you can. I know I've said this a few times, but I'll say it one more time: is that Medicare is not a free pass. It only may pay for potentially half of your healthcare expenses. So have a plan in place for saving for your out-of-pocket medical expenses and premiums. And whether that's just self-insuring, which just means saving, 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 and planning to spend it, or a long-term care policy or a Medicare Advantage plan, have that plan in place before your healthcare expenses actually start to rack up. And then think about your retirement income sources from your other sources of income for retirement plans, Social Security, savings, investments, and how you might be using these to cover your healthcare expenses. And all of this has tax implications, so I would encourage you to work with a tax professional, at least to visit with a tax professional, to make sure you're doing this in the best way, and getting the most tax efficient use for your Medicare plans, which is based on your taxable income, for how you're pulling out your retirement incomes, which we talked about last week, to try to keep in the most advantageous for you tax bracket as you navigate this whole system. So bringing it back to that first graphic you saw, health insurance is one of the 8 important retirement decisions. And if you'll see again on the library, you can see a couple of the other topics we've addressed. And next week, we'll be talking about protecting yourself from fraud, another incredibly important topic, especially as you get older. And here are some resources for you. That's my information up at the top. And you can often find me over at the library. Here are some other resources for you to check out. Probably the most important, easiest place to start is Medicare.gov. So if that wasn't dense enough for you on this early Saturday morning, I don't know what is. But let me see, I'll go to this question box. Let's see what kind of questions we have. Julie, Medicare Advantage. So the question is about Medicare Advantage and $0 premium plans. So the Advantage plans are the difference between the plans. Again, each actual A through L plan is regulated by Medicare. So the benefits offered in a Advantage Plan A or an Advantage Plan C at any company is going to be exactly the same. It will offer whatever, 3 days in a nursing home and 2 pairs of glasses, let's say, is Medicare. Made that up. That's not what it is, but that will look the same through each plan. What will be different is first of all, it'll be based on your income. So it might say it's $0 premiums, but it might have income eligibility limits. And it can also it can also change what type of premiums you have to pay or deductibles you have to pay. So if it's a $0 premium, well, maybe it's a 50% copay every time you need something. And so you can have HDPs, which are high deductible plans, where maybe you're not paying a premium, but you have to spend some significant thousands of dollars before the Medicare Advantage actually kicks in. So it is, there's a mind-boggling array of different types of policies. But no, nothing is ever free. And from what I have seen, it's different for each person. It's certainly worth looking at all of the different pros and cons to make sure what is for you is the best. And so we have another question of how much life insurance should we have if we still have a mortgage enough to cover 1 year of payments or 2 years? So I am going to give you a frustrating answer here that this is honestly too, I need too much more information here to be able to give you an answer. I'm happy to talk to you further one-on-one, sort of general about life insurance. And can I just ask how old you are? See you in there. 66. So the general goal, there's two different ways in which you can use life insurance. One key important piece of life insurance is to make sure that if the person who the primary income earner, if something happens to them, the survivor is able to pay off the mortgage, pay for the kids to go to college, pay for their own medical needs. The last thing you want is if your partner passes away, all of a sudden, I mean, as if that's not bad enough, all of a sudden you need to figure out how you're going to pay for things or move to another state or dramatically change your standard of living. So that's one form of the of life insurance, and so that would be, um, ideally the life insurance policy would be enough not to just pay for the mortgage payments, but to actually pay off the mortgage. That's the goal. So that way the survivor just doesn't even have to worry about the mortgage payments anymore. The other form of life insurance, as we talked about here, is to protect your net worth in case you spend down all of your assets in for your health needs. And so that's not looking to, it's not necessarily looking to protect you and your spouse, but it's looking to protect whatever legacy you're hoping to leave. So it's two sort of different types, but truly I would need much more information, personal information from you to give a specific recommendation. So I'm just looking, does anyone else have, does anyone else have any other questions that I can help you with? Or again, my information's here. Happy if you know have something more personal you want to reach out to me. I know this is certainly the most complicated of the four topics that we'll be doing through this series. And if not, I'll stay on for a minute with Matt, but reach out if you have questions. I hope to see you next week as we wrap it up with protecting yourself from fraud.